If you are listening to this episode well into the future, just know that we are currently living through some really interesting, challenging, and to some extent concerning times. The S&P 500 has been halted several times over the last few days because they have experienced massive volatility, 8%, 9%, 10% losses in the middle of the day. And the S&P 500 is off its February highs by about 26% right now. So the intraday swings have been in the top 10 worst intraday swings of all time. You can Google that, fact check it, but it's true. A lot of the other dates are from 1929, the late 80s, etc., dates that you are surely very familiar with. Now, the Fed has just announced that it's going to be reducing interest rates by about 50 basis points, 0.5%. And then they just announced again that they're going to be reducing again and are targeting a federal funds rate to be somewhere in the range of 0% or 0.25%. Now, what not a lot of people are talking about is the fact that the Fed also announced that they're removing the reserve requirement. They're making the reserve requirement zero. Basically, previously to this announcement, there had to be 10% cash reserves in each member bank. And that's really where we get the term fractional banking. You only have to have 10% of the money that you're lending out. Now, I'm not going to go into all the details here, but this will allow for more lending without the inhibitor of the reserve requirement. There is a lot of debate in the Austrian school about why this is not a good idea. And the founder of the Austrian school, Mises, was a big proponent of the gold standard and effectively wanted a 100% reserve requirement. So think about the difference in the implications between a 100% reserve requirement and a 0% reserve requirement. I'll link to an article about that topic in the show notes page. Here's the point. I think it's very likely that this could lead to recession by the formal definition of 2 quarters of negative economic growth. There are several industries which will almost certainly have negative quarters, and that alone can make it happen. So airlines, for example, hotels, retail centers, restaurants, gyms, all are on pause right now. Los Angeles basically mandated that all bars and gyms and pubs be closed right now until the middle of April. So if a lot of other cities do that, which I think they will be, you're almost locking in negative growth for at least 1 quarter. So that slows things down. But you have other industries where people plan things out much further in advance than just month over month. For example, the event business is getting absolutely hammered right now. South by Southwest is canceled. That's roughly $350 million of revenue that the city of Austin is not going to get. Ultra is canceled. Coachella is postponed. The Boston Marathon is canceled. By the way, I was very fortunate that the LA Marathon was when it was, because if it was just 1 week later, I'm confident that I would not have been able to run, and that would have been pretty sad. Now, Airbnb is also in discussion. They have basically announced to anyone that has scheduled something right now that it's okay to cancel without any fees. And I don't know what the fallout of that's going to be, but it's very, very significant. So the reason I'm mentioning all of this is to paint a clear picture as to where we are and the likelihood of recession being very, very high, in my opinion. So let's take a moment to recognize that if you've only been in this industry for 3 years or 5 years or 7 years, this is what it actually feels like. It doesn't feel like everyone is just screaming about how excited the potential sale is, and all your friends are chanting discounts, discounts, discounts. It's not like that at all, which brings me to my first rule about investing during the crisis, which is be respectful. Be respectful of what's going on. When this happens, people get laid off, people lose their jobs, people get their homes foreclosed, and people can't pay their employees. This is really sad because a lot of these people have other people depending on them. So the first rule of investing during a crisis is be respectful. On the other end of that spectrum, I've seen a lot of people posting on social media, see, this is what I've been telling you guys about investing in the stock market. I told you so. This is why I love real estate so much. Now is not the time for that type of attitude. That's not going to get you investors. Everybody that knows what you're talking about already agrees with you. And so it is what it is. But to step on someone while they're down, while they're facing a foreclosure, while they're facing a lease payment they're not going to be able to make, is not going to help you. So this is the first tip. Now, the second tip is control your emotions. This morning, I woke up and looked out the window and I saw something that I had never seen before, which is a line of 50 people waiting to get into Ralph's, which is a grocery store. Now, all of them had shopping carts just sitting out, waiting, standstill. They're literally letting in only a few people at a time because they don't want there to be a massive panic. Now, even if you're well prepared for something like this financially, seeing that in not only a first world country, but the country in which you live, the neighborhood in which you live, can really send some uncomfortable vibes down your spine. Emotions are a huge part of the investment world. There's a famous poker player quote from Phil Hellmuth after he was ejected and lost a major poker tournament. And the quote is, "If luck wasn't involved, I'd win them all." And this is kind of how the real estate game is played to a certain extent. If emotion wasn't involved, there would be no real opportunity for pricing arbitrage. And yet, there is, almost always. So the question is, how can you keep your head calm during these times? And I have a huge suggestion for this. It's something I've talked about before, and it's very, very straightforward. And on a risk-adjusted basis, it's very favorable, and that is meditation. I am 100% sure you've heard very successful people talk about why meditation is so important. You may have noticed that a huge percentage of successful people do this. And there's good reason for that. I'm not going to go into the details as to why this is, but if you're one of those people that is really analytical and you think that meditation is too hooty-tooty for you, I get it. That was me for a very long time. But guess what? The truth is, if you're one of those people that really considers yourself as an analytical, objective person, and that's why you don't like meditation, guess what? You aren't being very objective. Sorry, but there is a ton of data that backs up the fact that meditation and visualization can be very useful tools, not only for accomplishing your goals, but even for things like recovering from challenging workouts or stressful situations. Right now, because of the popularization of things like Garmin heart rate monitors or the Apple Watch, you can track your heart rate. Specifically, you can track your heart rate variability, which is a very good tracker of stress levels. And if you implement a meditation practice, you can actually see your stress levels decrease, and it will prepare you for overcoming challenging things at work. It will prepare your body for overcoming challenging things in the gym. So we are going to do a meditation challenge. First ever Cashflow Connections Real Estate Podcast challenge. We're going to do it. Meditate 20 times in 30 days. That's the challenge. Literally sit for 10 minutes, 20 times in 30 days. I know you can do it. If you've never meditated before, this is the time to try. Headspace right now is doing a free trial, free 10-day trial. It's a free course that's 10 days, starting with the absolute basics and working your way to make you feel comfortable. I have a referral link, which yes, I probably get like $5 or something like that. I'm not really sure what it is, but I get some sort of bonus and I'm keeping it in the show notes page so you can have access to that. So click the link. You'll be able to access your free trial. And it's a 10-day introductory course that you get access to. So this will get you through your first 10 days. And you can join us in the Cashflow Connections Facebook group and tag me on Instagram, _HunterL_Thompson, to track your progress. And yes, if you do tag me, I will shout you out and give you a repost. So that's the second tip, which is control your emotions. Now, the third tip, we've gone through the emotional stuff. We've gone through respect. We've gone through getting your mind right. Now it's time to get into the numbers. This is the type of opportunity that does not come along very often. It's time to overcome the surrounding chaos and put in practice what we've been talking about all this time on this show. Ever since I've operated the show, we've discussed a buying opportunity. Now, real estate moves like a barge, unlike the stock market, but it's very clear to me that there's going to be some opportunities coming. I'm very interested to see how this plays out. But I wouldn't be surprised if this panic did not cause the combination of two amazing things when it comes to real estate, which is decreased prices and decreased interest rates. The combination of these two things is very, very rare. But my goodness, if you can find a quality asset, and because of the combination of the decreased prices and the decreased interest rates, you're basically effectively buying a property at a mortgage rate that would imply that you're buying a property in 2014 or something, that is very favorable. Now, without even getting into the price devaluation which could come, let's just talk exclusively about interest rates. Now, let's say you're buying a property with $1 million of NOI that previously was trading at a 5.5% cap rate. So this would be valued at an $18 million property. Now, let's say you put 33% down, which is about a $12 million loan, and assume a 4% interest mortgage. And let's just say it's interest only to keep the numbers simple. That is about $40,000 per month as a monthly mortgage. Got that? $18 million purchase price, $12 million loan, $40,000 a month in mortgage. Now, if you take 100 basis points off that interest rate, basically 1%, if you go from a 4% interest rate to a 3% interest rate, that brings the monthly mortgage down from roughly $40,000 a month to $30,000 a month, somewhere in that range. Basically a 25% decrease in your monthly mortgage, which is the same if the property purchase price wasn't purchased at $18 million, but was actually purchased at $13.6 million. Now, there are some moving parts here, but the point is the mortgage is decreased so significantly that it's basically like the purchase price went down by 25%. Now, what typically happens when these things take place is that they balance out over the long term. So if you see interest rates drastically reduce, all things being equal, you see prices increase. But we don't live in a world where all things are equal. We don't live in a world where we're looking at things over the long term. We live in a world in the here and now. And if I can buy a property right now at a purchase price that I would have only been able to buy the property in 2014, because we're talking about a 25% discount or something like that, that is an amazing opportunity. This is why these types of opportunities don't come along that often. These decreases in prices aren't that common in real estate. And it hasn't started to happen yet, but I'm very confident that we're going to see that. And when it does, you have to be ready. You have to be respectful. You have to have your emotions in check. You have to be prepared to make that decision when everyone else is panicking. But I think that the opportunity is coming. So we want to make sure that everyone's healthy. But this is the part of the market cycle that many of you may have been waiting for. And this is what it's all about when it comes to being able to act without emotions and look at things objectively. So hopefully that helps. A couple different tips. Man, I am very interested to see how this plays out. All right, hope you enjoyed it. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.